All right. So again, Michelle Boyce, your moderator for the evening. And our February topic is long-term care planning. So I have the pleasure of introducing our two speakers tonight, Mr. Howie Simon and Mr. Stuart Appel. So Howie's joining us tonight from Rampart, who's one of our partners. He has been in the insurance industry since 1989 and specializing primarily in the long-term care market for the last 4 decades. So over that time, as you can think, he's seen that industry start, grow, shrink, and now evolve to where it is today. So he's really seen kind of the entire progression of the long-term care industry. Throughout his years, he sat on various product committees, advisory committees, and also lectured to the public and taught continuing education on this subject. So Howie, we thank you for joining us tonight and bringing your expertise.
Happy to be here.
And most of you already know our very own Stuart Appel. Now, Stuart's been helping RFS clients for the past 43 years, so a long time there, Stuart, with their long-term care needs. Throughout that time, he's worked with a lot of clients. He's heard their personal experiences from a loved one who needed care and seeing both the financial and the emotional stress that can take. So Stuart's going to talk to us tonight and bring kind of those personal experiences as well. So Stuart, thank you.
My pleasure.
All right, so why did we choose long-term care as the topic for our webinar this month? Okay, and the reason we did this is because this is becoming a really growing and large eroding factor that we're seeing in our clients' retirement and legacy. We all know that the population is continuing to age and live longer due to modern medicine, which some see as a blessing and some might see as a curse. But the reality is that we all are living longer, right? And because of that, there is more of a chance that you're going to need some sort of care in the future. Everyone probably knows of at least a handful of people that are in their 90s. And I would bet that most of you even know a couple people that are in their hundreds. Okay. And because of that, we're living longer. There's that higher probability that we're going to need care at some point. And we don't necessarily mean full nursing home care. It could be care comes in all shapes and sizes. So it could be at home care 1 or 2 days a week up to full care. So if you see the infographic that we're sharing at this point, statistically about 70% of individuals turning 65 or older today are going to need some sort of care. So that's why we chose long-term care as our topic. So we want to accomplish by the end of tonight is that we're giving you some ideas and material that you can walk away and say, I now know what the right questions are to prepare myself so that I can take the right steps in building out a long-term care plan. All right, so with that, Howie, a nice transition of what are those questions that people should be asking themselves as they address long-term care? And can you help kind of elaborate on each of those?
Sure. Okay, so we have 4 questions, the long-term care 4 questions. And if you see them before you, it's who will provide the care? Where will I receive care if and when I need it? How much is it going to cost? And if I do need care, how will I pay for it? Or how will my family pay for it? So what we really need to do first is define what long-term care is. And right away, people have the concept that, oh, long-term care means I'm going to be spending time, I'm going to a nursing home. But that's not necessarily what long-term care is today. If I were to read you a specific definition, the definition of long-term care, it basically refers to a variety of services that are designed to support the needs of people who are living with chronic health problems, which those problems usually preclude someone from performing their normal routine activities of daily living. And long-term care services include medical services, custodial care, homemaking services, social services, and potentially housing. So again, long-term care does not necessarily mean a nursing home. And there are different settings for long-term care, and Stuart will talk about that a little bit more later. But services today are primarily community-based, which means whether it could be at home, assisted living, adult daycare, and of course, yes, indeed, nursing homes. So we often ask who will provide the care and what will happen if and when I do need the care. What's going to happen with my family? How will it affect my family? That's the question that you really should be asking yourself. It's not necessarily listed here, but you have to ask yourself, what will happen to my family if I need care? Will my wife be able to take care of me? Will my children? Where will I also receive care? And how does care impact my family? That's something that you need to be asking yourself. So you also need to ask, do I have a plan? Do I have insurance? Do I have money set aside? What have I done to plan for long-term care? If you don't have a plan, unfortunately, that's a plan. It may be poor planning, but it is a plan. So we ask ourselves, who will provide that care? Is it going to be a spouse? Is it going to be a family member? Or is it going to be somebody that we ultimately hire to assist? The next question is, where will I receive care? I would obviously prefer to stay at home, but I may not be able to stay at home. And if I need care in a facility, who's going to pay for that care? And how will I pay for it if I have to? And then the questions come up, will Medicare pay for care? And we kind of know the answer to that because people feel that Medicare or the government is going to pay for that, but Medicare really doesn't pay for it. And if you've ever had an experience with your own family members, where Medicare comes in is Medicare pays for skilled care, potentially for up to 100 days. And Michelle will talk a little bit more about that later on. But Medicare does not pay for long-term custodial care. Eventually, Medicaid could potentially pay for care, but in order to qualify for Medicaid, you would have had to spend down your assets. And often, Medicaid would prefer you be in a Medicaid facility than paying for full-time care at home. So when you say, where will I receive care? You need to decide how are you going to pay for it and where are you going to receive it? And if I receive it at home, will the cost be covered by someone else, or is it coming out of my pocket or from my family? Next, how much does care cost? Well, you saw on the first slide that the average cost for a semi-private room in a nursing facility could be around $94,000, $95,000 a year. Now think about that for a second. 95 or 95, 94, $95,000 for semi-private room in a facility. If you're using up that money and you are living on a pension and 401k and investments once you're retired, how will that expenditure affect your family, affect your spouse, your partner, affect your children and grandchildren? If you have to use close to $100,000 of after-tax dollars to use for care, what impact is that going to have on your family? You need to ask yourself that. And then finally, how will you pay for that care? What is the best way to do that? Well, obviously, you could spend your own money. You could liquidate assets. You could sell investments and or real estate. But is it the right time? Is it the wrong time? Am I going to have a fire sale? Do I have to sell a building or a property or my home in order to be able to pay for that care? Will I have to liquidate my investments in order to make sure that I'm properly cared for or my spouse is properly cared for. So again, you could spend down your money or your family could spend their money. And again, you're liquidating, but is the timing right to sell some of those assets? You could spend down and end up with Medicaid and basically impoverish yourself. Now think about it, Medicaid, the last three letters of Medicaid, aid, it's having the government pay for you and pay for you in a Medicaid approved facility or a Medicaid qualified and approved provider. Now, is that somebody that you may or may not want to have as far as somebody who's going to render care or come into your home potentially? Or the final thought is to potentially transfer the risk to an insurance company. And that's one of the reasons we're here tonight, is to make sure that you have a plan. And if transferring the risk or that exposure to the insurance company is something that you may want to think about, because as Michelle started this program, long-term care planning has to be part of any type of retirement plan. Think about something for a minute. Long-term care provides asset protection. When you're younger, we often have what we call disability income insurance. Disability income insurance protects your ability to earn a living, and it protects your income if for some reason you can't work and you can't earn your income. Where long-term care is just another form of what we call senior disability. Senior disability is designed to protect your assets and to keep your family whole. One of the things that I've often said is if somebody has a long-term care policy and the policy is triggered, and Stuart's going to talk about policies in a few minutes, if the policy is triggered and you're collecting from that insurance policy, very often what it does is it provides the liquidity and it provides the comfort to you and your family so that your kids are not fighting with each other. It provides also, obviously, peace of mind and peace between the siblings. So again, how do you pay for long-term care? You pay for it either out of pocket, you rely on the government after you've liquidated your assets and potentially impoverished yourself, or number three, you figure out a proper plan and you potentially transfer the risk to an insurance company. So with that, I'd like to pass it back on to Michelle.
Thank you, Howie. So a lot of great information there. I like the way that you broke that down into each segment. So it really gives people, I think, spoonful knowledge that they can apply. So you mentioned on that last section, transferring the risk using insurance. So Stuart, you've been helping clients for a long time with that option. Can you help educate on where the long-term care industry has evolved throughout your career? You've seen kind of the ups and downs of it and kind of where we're at today.
Sure, absolutely. Thank you, Michelle. And thank you, Howie. So the long-term care marketplace has really evolved over the years. So in the early 1980s, long-term care insurance was introduced into the market, and coverage was really just limited to nursing home only coverage. And that's clearly not the case today. Today's policies are much more comprehensive. What happened in the early 90s was that more carriers began to offer long-term care insurance, which covered not just facilities, but also at-home care. Because as Howie mentioned, when people need care, ideally they want to stay at home, and that's where they're most comfortable. So ideally you want to stay at home for care. So policies in the 90s started offering that. Fast forward to the early 2000s, a number of carriers that offered the long-term care insurance actually dropped out of the market, and they either sold their book of business or they still continue to service it. Many people, even myself, that have older policies have experienced some rate increases over the years because traditional long-term care insurance premiums are not guaranteed. So a carrier does have a right to file for a rate increase with the state insurance department by demonstrating the need. And when that happens, the state insurance department can do one of three things. They can approve the rate increase as applied for, they could reject it, or they could modify it in some way by giving a lower rate increase. When that does happen, an insurance carrier can't assume that an insured can pay the new premium because many people might be on a fixed budget at that time in their lives. So when there are rate increases, the carriers will give you a choice of modifying your coverage in a way to help mitigate the rate increase. You could obviously accept the rate increase. In addition, carriers actually give you the opportunity to cancel the policy if you'd like at that point of a time of a rate increase. And if you do that, the total premiums that you've paid into the policy can be used for future long-term care claims. Now, what's happened in recent years is carriers responded with innovative products, which actually can be used for more than just long-term care insurance. So this way, it answers the question, what happens? I have this insurance for all these years, I've been paying these premiums, I never had a claim, what happens? So the short answer is consider yourself one of the lucky ones. Ideally, you want to have the insurance, but never, need it, never use it. But with that said, with today's products, which are more innovative, there are essentially fewer carriers offering coverage, but more unique options available. So the three coverage options that are available in the marketplace today are traditional long-term care insurance. So when you think of traditional coverage, Howie mentioned senior disability insurance. So with the traditional policy, you have a daily or a monthly benefit amount. There's an elimination period or a waiting period. So there's a number of days that benefits are not going to be paid.
Your deductible.
And think of it as a deductible, yes. And then you have a benefit period. How long are benefits going to be paid in the event of a claim? Okay. Up until a couple of years ago, that was really the only type of coverage that was available. So I had mentioned that there are now some unique options, such as what's known as a hybrid policy or a hybrid product. So with that product, there are actually three ways of getting benefits under that type of policy. So first and foremost, it pays a long-term care benefit in the event of a long-term care need. Okay, that's the reason why you would take out the coverage. But secondly, there's a small life insurance component in the policy if someone doesn't have a long-term care event and they pass away. And then the third way of potentially getting a benefit from the policy is if at any point in the future, for whatever the reason, someone says that they do not want to have the policy anymore, they want to cancel it, they could actually get back a portion of the premiums that they paid. Okay. The third, a majority, yeah. In other words, you could get back as much as, 60, 70, 80%, and possibly even more, depending upon when you decide to cancel the policy.
So with a hybrid, somebody gets something out of that policy.
Exactly. So the money is not, paid for nothing. There is a benefit paid in some way, shape, or form, a long-term care benefit, a life insurance benefit, or cash out. The third different way of providing for long-term care is some permanent life insurance products have what's known as an accelerated benefit chronic illness rider, where if someone has the long-term care need, or they have the ability to actually accelerate the benefit if they also have a terminal illness. So they could accelerate a portion of the benefit. Now, bear in mind, with that chronic illness rider, it's not a dollar for dollar benefit. Okay, so when it comes to product choices, if someone is looking to insure a majority of their exposure, it's not with that accelerated benefit rider. Okay, but with that said, it's a nice added feature that some permanent life insurance policies do have. And generally, it's a no-cost option until you actually use that rider on the policy.
Thank you, Stuart, for summarizing those three different types. So this is where we have scheduled in a break. So if anyone has any questions, if they want to put in the Q&A feature in the toolbar, go ahead and type those out, and then I will read them, and then we'll have either Howie or Stuart answer those. So I'll just give a quick second to give you time to do that. All right, so I think either one of you could answer this question, but one of the questions is, between the second two options that Stuart described with the hybrid and the life insurance with long-term care, what do you see more people buying these days? Like what has a bigger interest from the consumers?
Can I take that?
Sure. And then I may chime in also.
Okay, well, if somebody has a true need for long-term care, we really see hybrids being the answer. The answer to that, because what happens is when you buy a hybrid, what's nice about it is, again, Stuart mentioned that somebody is going to get something from that policy no matter what. And a hybrid gives you a large amount of long-term care, but it also provides a small amount of life insurance. So no matter what you pay into that policy, somebody is going to get something out of that policy, whether it's you or it's your beneficiaries or a combination. So if you pay in $100 into a policy, I'm making up a number, somebody is going to get that $100 back at some point, whether it's received as a long-term care benefit or if it's going to be received as a life insurance benefit. So no matter what, somebody gets something. You're taking today's dollar and putting it in tomorrow's pocket.
What I would add is when we're talking to clients about long-term care insurance, we don't come in with any preconceived notions. So what we'll do is we'll educate you on the different product choices. So we're going to show you the cost for traditional coverage as well as the cost for hybrid coverage. Now, bear in mind, there are a few key differences in terms of the premium structure. So when it comes to traditional coverage, you're actually paying the premium each and every year for the rest of your life. Okay. In addition, as I had mentioned earlier, those premiums are subject to potential rate increases in the future. With regard to the hybrid coverage, depending upon your age, there are only three ways of paying for it. There's a single pay where you pay one premium. There's a 5-pay where you pay premiums for only 5 years and then 0 thereafter, or you pay premiums for 10 years and 0 thereafter. And those premiums are guaranteed. So there cannot be any rate increases in the future. Now, with that said, the premiums for the hybrid coverage is going to be more than the traditional, the premium year by year.
Because you're paying it in a shorter period.
You're paying over a shorter period of time, but you're also guaranteed with those premiums. So if someone has the cash flow to pay for the hybrid, there are definitely reasons why that's something that should be considered, because again, as we had mentioned a few times already, there are three ways of potentially getting a benefit. But you're guaranteed to get some type of benefit from that policy.
And and just to answer the last question, that they also asked about the life insurance. So again, the hybrid really works great for the long-term care need. The life insurance product with the chronic illness or the long-term care rider, that is a great way to have coverage for long-term care if you really need the life insurance. So again, if I were to give you an analogy, the life insurance, a life insurance policy with a long-term care rider, and a rider is basically an option. The long-term care rider is the side dish, and the life insurance is the main course.
Another question in the chat that I'm going to get to in a second. But Howard, you made a statement about buying, something in today's dollars to use in the future. Doesn't the hybrid option allow for an inflation rider where those benefits can increase to help offset that cost?
Yes, that would go along with product design. So when we design a product, sometimes what we'll do is there's 4 components when you buy any type of long-term care. Basically, it's the daily or monthly benefit. Stuart referred to as the waiting period or the deductible, the days that you have to wait before the policy kicks in. And typically we use a 90-day elimination period, which serves as your deductible. And the reason we use 90 days most often is because the federal government said, in order to consider a policy a chronic illness policy, or a policy that addresses chronic illness, whatever ailment, illness, or injury that's causing the person to require care must have the expectation of lasting at least 90 days. And the reason for that is anything that is less than 90 days is not considered to be chronic illness. So again, we have what you call the core 4 when you develop a policy or design a policy: your daily or monthly benefit, your elimination period. Then you have what Stuart referred to as how long will the policy pay out once I go on claim. So that's called the benefit period. And the 4th component is, do I add an inflation rider or an inflation option to my policy? So if I'm starting at a certain dollar amount in 2024, if I don't need the coverage until 2040, I want that policy to grow over the years. And again, that's going to really depend upon the individual, your age, etc., and which plan we actually could design for you.
Okay, so another question in the chat, Stuart, you spoke about, the changes that we've seen in the long-term care industry. And as it's being pointed out, early on, those policies were very much mispriced. Actually, like they were underpriced for what their claims history was going to be, which now has had consequences for the policyholders with those raising premiums. So with that being the past, how does one then trust that these policies today are going to not have that same impact in 10 to 20 years?
Okay, so there is no way of guaranteeing that there will not be a rate increase with a traditional policy. Okay, the hybrid policies, as I've said earlier, those rates that you pay either in one lump sum, 5 years or 10 years, are guaranteed. But traditional policies, rates have changed for new products, new traditional policies over the last few years. So carriers are hoping that the products today are priced more appropriately, than the older products. But there really is no guarantee that there would
Also,
not be a rate increase.
may I add that also underwriting is much more stringent than it was 20, 30 years ago. 20 or 30 years ago, most anybody was accepted for coverage. Today, you really have to be healthy enough. So it's much wiser to buy long-term care insurance when you're younger and healthier before issues develop as we age. So we always recommend, what's the best time to buy a policy? Now.
Right. Yeah,
If
I mean,
you're
just to
healthy.
give you a personal example, I mean, I took out, the policies for myself and my wife probably about 14, 15 years ago. And we've experienced considerable rate increases. I mean, about 5, 6 years ago, we got about a 92% rate increase. And then I got a letter a few months ago saying that this summer, okay, summer of 24, we're going to be experiencing another 40% rate increase, 10% over the next 4 years. Now, with that said, even with those rate increases, the cost for coverage today would be considerably more than what we're paying. Plus, because of the inflation factor that we have on our policies, it's grown to the point that you can't even buy the monthly benefit that we currently have today in a traditional policy.
Policies
So,
20, 30 years ago were completely mispriced, completely, for
right.
several
Plus, we
factors.
were in a very low interest rate environment for many years. Carriers also price lapsing into policies. And the insurance carriers found that people, when they take out the long-term care insurance, they don't lapse the policies. They keep them
Too
in
valuable.
force. Yeah.
So I think to summarize the answer to that question is that the past is the past. And the one good thing is that the carriers learn from those mistakes. So the consumers today have much better options that are priced much more accordingly to when they're going to need it in the future.
And if you want a guaranteed premium, then go with a hybrid because that is truly guaranteed.
Absolutely. All right. So Stuart, one question I know that always comes up is that, okay, if someone says, okay, if I purchase long-term care, what will it cover and when? How we talked about some of this earlier, but if you want to
Right.
elaborate a little more on that subject for us.
Sure. So policies today, as we said, cover home care, assisted living facilities, adult daycare, nursing facilities. The trigger to qualify for long-term care insurance is if you cannot perform or need assistance with 2 out of the 6 ADLs or activities of daily living, which are eating, dressing, bathing, toileting, transferring, or continence, or if you have a cognitive impairment, such as dementia or Alzheimer's. And as Howie mentioned, it has to be anticipated that it will be a period of 90 days that you're unable or need assistance with these activities. So 90 days is the most common elimination period, waiting period, deductible, whatever you want to call it. Although for traditional policies, we can add a 0-day waiting period for home care. Now, even though benefits are payable from day one for home care, it still has to meet that 90-day need.
The expectation.
Okay? The expectation that you're gonna have that need for 90 days. Now, depending upon the type of policy you have, would determine how long the benefits would be payable. Typically, most policies offer anywhere from a 2 to a 6-year benefit. Years ago, it was common for most carriers to offer a lifetime benefit. Today, that is not available with many carriers. There were a couple of carriers that still offer that, none of them in New York, I believe.
Correct.
And I think part of the reason is, carriers were seeing a lot of people were buying lifetime benefits. And if you look at industry statistics, most claims are probably under 5 years. So I think carriers felt that people were being oversold by buying a lifetime benefit. But with that said, a lot of people bought it. I have a lifetime benefit, and I'm very happy that I have a lifetime benefit. We did talk about the inflation factor, very important, because again, if you're going to be buying the coverage when you're young, so if you buy a policy today for, say, $7,500 a month of benefit, just as an example, if you're going to have a long-term care event in 15, 20, 25 years from now, if your $7,500 a month benefit was not growing year by year, you're going to be dramatically underinsured. So it's important to consider adding inflation to the policy. And I'll take more questions if there are any.
No questions yet. So Howie, kind of with that thought of, Stuart's example there, so, okay, if I have 7,500 today, it's going to cost more in the future.
A
A
month.
month,
7,500 per month.
That'd be a lot of coverage. It was per day. It's obviously going to cost more in the future. So people are probably thinking, well, what is the cost today? And how much coverage should I get so that I can have substantial coverage when I need it in the future?
Well, let me just go through a couple things. We talked about a semi-private room being in the 94,000 range, again, on average. And if you look at this chart, you can basically see what some of the numbers look like as far as facility care. I was on a webinar yesterday where we were talking to somebody who was a care coordinator, who is there's services now that have developed where if you need care, you hire these folks and they help to set up care. And she was basically saying that if somebody were to have hourly work come into their home, an hourly caregiver, a home health aide, the cost was anywhere, depending upon where they were in the country, starting from a low of $22 an hour to even up to $37 an hour. And often they charge a minimum of 4 hours. And if you want less than the 4 hours, then the rate goes to $50 an hour. So it doesn't make sense not to have really the whole or the full 4 hours. So you can see what the estimated inflation is on these policies, or I should say, on the cost of care. So very often you need to ask yourself, again, how will I pay for this? If I need to come up with $120,000, $130,000 a year for one spouse, God forbid it's two, or one partner in a partnership or a marriage, what will happen to the family and how long can that family sustain paying these costs? So keep that in mind. I wanted to just go over a couple things just so that you think about this additionally to when you're talking about long-term care, is that there are some myths involved with long-term care. And the first is people believe that health insurance or their health insurance may cover long-term care services, which is not true. It may cover some private nursing for a specific period following a hospital stay, like Medicare, for a limited period of time, but it will not cover an extended care situation. I also mentioned Medicare. Medicare will not cover long-term or chronic care. Medicare limits the coverage to skilled care after a 3-night hospital stay, and it's broken down into two pieces, day 1 through 20 and day 21 through 100. But after that, it's not covered. And day 21 through 100 has a significant copay. Medicaid will cover long-term care, but only after you've spent down your assets. Now, one of the things that we talked about earlier is what age is the right age to buy this? And I said before, today. I say that for two reasons. Number one is the younger you are when you look at any type of long-term care coverage, the less costly it's going to be. And secondly, and maybe more importantly, is usually the younger you are, the healthier you are, the more healthy you are, so that you can actually qualify for a policy, because they do look at medical history when somebody is looking for some sort of coverage. Another myth is that people think that if they're a veteran, that veterans will cover or will be covered for home care, that sort of thing. And it's very, very limited as far as veterans are concerned. And finally, if you do not spend down your assets, again, the only thing you can do is pay out of pocket or transfer the risk to an insurance company. So long-term care, again, protects your assets and retirement. It allows your family to oversee the care, and it provides the liquidity to help you defray the cost of long-term care. And something that you should keep in mind is that you're looking at these numbers right now. It doesn't mean you have to insure for this whole amount. What we normally recommend is that you insure enough so that if you have to take some money out of pocket, that's fine. But Michelle was talking a little while ago, if you have a policy that pays $7,500 a month or covers cost of $7,500 a month, and your cost is $8,000 or $9,000 a month or $10,000 a month, so you're only laying out $2,500 a month, but $7,500 is borne by the insurance company. That's okay. The idea is to pass the exceptional cost or that exposure to the insurance company. So, last thing I wanted to mention is that if you have a business, long-term care premiums, and we won't go into all this now, but potentially could be deductible, or portions of the premium could be deductible to businesses, and you are allowed to buy it on a limited class. You don't have to buy it for everybody, and the business can pay for it.
And
Shall?
also, Howie, one other point,
Sure.
some states have a tax credit
Yes.
for the long-term care insurance premiums that are paid, New York being one of them.
In New York, yes, there are certain rules. So you can get an actual credit and a deduction. So the deduction is potentially federal. It's a federal deduction for businesses, but a credit is a state credit. Again, not everybody is eligible, but it's certainly worth exploring.
Well, and I think on the other side of that, right, some states are imposing a tax if you do not have some sort of long-term care coverage because they see what impact this is going to have in the future. So they're really passing that down to the consumer, wanting them to take some sort of action.
Right. In Washington State, it's been imposed.
Yes.
California's thinking about it. New York, they're talking about it. It's a few years down the road, but what they're maybe thinking of doing is imposing an automatic tax and giving a tiny, tiny little benefit of $100 a day, which will certainly not cover it for a limited period of time. And if you don't have your own long-term care policy in place, then you may be subject to that additional tax. which by the
Right.
way could be, they say up to 1% of your earnings.
So thank you, Stuart. Thank you, Howie. So I think for some closing comments before we go to questions to just summarize the evening, to close on some key takeaways. The first is that long-term care needs to be part of your plan, part of your retirement plan, right? Just as you plan for other things of what your income and expenses are going to look like, this should be stress test in there to see how it will impact it. How does it affect your family? And if you're going to go the insurance route to fund portion of that, as Howie just mentioned, the younger you are and the healthier you are, the better rating you're going to get for the policy and less out of pocket premium. And then lastly, when you decide, that you're going to get coverage, you should think about how much you're going to insure. And it doesn't have to be the entire amount, right? But it should be something that's going to allow that plan to work. Any other key takeaways that you guys think we should walk away with tonight?
I'll add one more thing. I just want to say, you mentioned earlier that I've been doing this for a long time. And although I've seen policies change quite a bit over the years, and companies come in the market and leave the marketplace, when a policy pays, it does two things. Number one, it allows the family to stay together. And that is it keeps the kids from fighting. I mentioned that earlier. But it's nothing short of a miracle when that money is coming in and the caregiver is paid and the insured is receiving care in the place that they want to receive. It makes the caregiving situation or the individual who's receiving the care, it makes them whole. And there's nothing better than keeping everybody civil and making sure that care is rendered exactly as the family wants it to be.
Absolutely. It helps keep that sense of dignity.
Good word.
Yep.
All right,
I would agree.
let's open that back up now to any last questions, from the content that we covered on the second half of the hour here. So if anyone has any additional questions they'd like to put in the Q&A, fire away and we will answer those. So while we're waiting for finish typing there, so I will just ask a question to you both, because we covered a lot with statistics, and why you need care. But since you both have been, doing this for a long time, if you both could share just any personal stories that you have that you've seen the impact and the difference that someone having a long-term care plan has made for themselves and their family.
I mean, just to echo, I'll jump in. Just to echo on what Howie was just talking about, we have an existing claim going on right now.
Your family.
I'm sorry?
Are you talking about your family? Is that
No, it was a client.
One of your clients. Okay.
We have a client who's currently on claim right now.
Yeah.
And I've been having a lot of interaction with the insured's children, and it's made a world of difference, him having that policy. Because first of all, it's, pretty big financial responsibility, the cost of care. Now he's having care at home, which is, again, the ideal place of where someone, wants to have care if they can. This way they're in their familiar surroundings. It just makes things a lot easier if someone, if an older person can stay in a place that they're comfortable with, it makes a world of difference. So the fact that they're getting a check, month in and month out, and it's been going on for about a year and a half now. It's just made a world of difference. And, I get calls, periodically from the children, just checking in and, thanking me for, really making sure that their parents, took care of this important need, many years ago. They took out the coverage probably about, close to 20 years ago at this point. Again, probably never thought that they would ever, have a need for the coverage, but here they are, they have it, and it's working. So,
Well, nobody ever thinks it's going to be, they're
correct,
going to care. I mean, that's the,
correct.
two things I wanted to just add is, first of all, with traditional long-term care, if you're on claim, your premium is waived so that you are not paying premiums when the policy is paying you. And second, which might be very important, is that I want to just tell you 64% of all the claims are female. So what does that tell you? That tells you that females live longer, but it also means more females eventually will need care. So it's just something to food for thought, that it's so important, especially for women.
And I always think about, the statistics are what's actually reported. How long has care been going on in the home from the wife or the oldest daughter, which tends to who it be before it gets reported, right? Before it becomes on the radar of a statistic.
Right.
So there's always those things that happen behind closed doors that having some sort of plan helps alleviate that stress.
Right. Okay.
All right. Well, that is everything we have for this evening. So I want to thank everyone for joining us. Howie and Stuart, thank you for bringing your expertise to this webinar this evening.
Our
And
pleasure.
we will be back next month. And in March, our topic is going to be estate planning. So have a good night, everyone.
Good night.
Thank you.